Okay, ladies and gentlemen, welcome to FOMC with your host, Tony, also the head financial analyst at FinancialJuice. All right, so let's get into it. Good evening or afternoon, wherever you may be. Good FOMC day, everyone says, is Dan the Trader. And yes, good luck to everyone as well. So let's get into it. We're going to discuss what is FOMC, what is current sentiment surrounding the Fed rate decision, what lies ahead in the future for the Fed. Do they pause at this meeting and then decide to hike at the following meeting, depending on where they see inflation? Is it down enough for them to just continue holding, or do they think they need to do more work in order to raise interest rates? But first, let's get into what it is. Roughly, they meet every 6 weeks over 2 days, and then they set the policy and federal funds target range. Now, today, we're going to be getting extra bit of data. That's the summary of economic projections. If you've seen it in the past before, that's more or less, it's just a table with a bit of data and explanation as to where they see monetary policy in the future, and that's talking about the Fed funds rate target, PCE inflation, GDP, and the unemployment rate, so on and so on. And they're kind of breaking down as to what their thoughts are. So this week this meeting is going to be quite interesting for future expectations of whether or not the Fed is likely to continue with their rate hiking path, or if they're going to stick to where they are, stick with where they are from this meeting onwards, rather than what traders and economists are thinking, that the central bank might pause at this stage and then do another rate hike in the July meeting. So, of course, the rate is a bank that they charge. The rate is that banks that charge each other to borrow or lend excess reserves overnight as well. So again, quite a key, of course, if you don't know, a very, very important decision to be made today, and will then have a likely knock-on effect on what other central banks may do as well, whether or not they follow in the same path as the Federal Reserve does. Now, if you found these past live streams are useful, and if you've joined me for the FOMC Live, then don't forget to share the video, like it, subscribe to the channel, and get the word out there. Now, why is it important? Of course, the macroeconomic effects and also the effects on the market. We know that it causes volatility in markets, and then, of course, affects the wider economy. How it may, as said, it may influence other central banks to follow in the similar path, rate path. And also, of course, you've got to think about businesses. When you raise rates, of course, borrowing costs go higher, not just for businesses, but also consumers too. And then those who are also paying back mortgages or looking to take out a mortgage on a house, again, that is something that has a big influence in the spending area. The hope, of course, is if you raise interest rates high enough, that will stop people, or will slow down the amount of borrowing, and in turn slow down the amount of spending, which will then lead to consumer prices continuing to head down in a way that the central bank would like to see it do. Now, how does it affect the markets? So the currency, very simple, easy. Whenever you raise rates, that raises the value of the currency, because you have international investors and traders that will forego their currency in exchange for a rate that gives them a better rate in return. Particularly those who are investing into the bond market as well, right? If the yield is higher in one nation that has a reserve currency, the world reserve currency, then they're more likely to jump into that currency and also into the bond market as well. With the stocks, of course, as I've just said, you raise the borrowing cost, and lending becomes tighter by naturally. That will put off businesses from taking out loans. It may mean that they become less productive in the future. Consumers may have less spending, and in turn, that will damage stocks and their valuations, and also dampen the economic outlook. So overall, what could happen within the stock market, and what we have seen recently in the stock market too, or let's say over the past year or so with the tightening cycle, the last 10 months from the Federal Reserve, is that you have had a shift from the stock market, the riskier assets, into the more safe haven assets instead, looking at the bond market, looking at the dollar. Of course, in the short term, when you're looking at how the markets move around, whenever you have a central bank speaker saying, hey, we might decide to continue raising rates, or inflation isn't down enough for us to say that we're done with the rate hiking cycle, a lot of the pricing happens at those points. Again, another key reason why it's important to keep an eye on what the central bankers are saying, because then, as said, it has that short-term effect. But then over the long term, usually the effect isn't that positive for the stock market. Now, for bonds, I've just kind of briefly talked to you about it with the currencies, but whenever interest rates are raised, the value of the yields of those bonds, okay, they rise. And what happens is that they rise because the expectation is that central bank, one, has raised rates, two, depending on what the central bank says, those yields may rise even further in anticipation of further tightening, and those bonds become more attractive. So what happens to bond traders? So those who had a bond, maybe let's say 5%, and then the central bank raises rates, and the bond that person or group of people held and then a new bond is issued at 7%, then those people who had the bonds at 5% would rather might decide to forego their current one at 5% and jump into a 7% bond, giving them a higher rate of return, which of course we have seen with the likes of some of the banks with the SVB fallout and how they were affected, or Silvergate as well, how they were affected with the bonds that they had of government bonds. Of course, with the super quick rates that were done by the Federal Reserve, that means it's hard to catch up, and the liquidity issues start to build up. So that's how the markets are affected. But then we also talked about a bit about the macroeconomic effect as well. Then where is the economy at the moment? These are the economic indicators that the central bank or the Fed will be looking at in determining what they do with their rate decision and what their rate path should look like. So GDP quarter-on-quarter, not great, but still better than being flat at 1.3% for Q1, Q4 compared to Q4 of 2.6%. Inflation, as we had this week, came in at 4% compared to 4.9%. So a lovely bit of a downside movement in inflation there. Of course, when we did cover the release yesterday, the market reaction it was a bit choppy because you had one of the bits of data that was higher than expected, and then it was a bit mixed. One was lower, and the other couple releases were as expected. But again, inflation over the CPI year on year down at 4% compared to 4.9%. PCE price index year on year was slightly higher, 4.4 compared to 4.2%. Consumer spending at 0.8% compared to 0%. Non-farm payrolls, 339k versus 294k, so solid amount of jobs being added within the prior month. ISM manufacturing PMI slightly weaker, 46.9 compared to 47.1. Services PMI 50.3 compared to 51.9. Now, with the ISM or the manufacturing or services PMI data, one of the things that we have to consider is that a figure above 50 usually denotes that that area of the economy or sector is in expansion territory. A figure below 50 shows that that area is in contraction in that territory instead. So that's one thing we have to be aware of, that if the manufacturing sector or the manufacturing side of the US economy isn't doing well, particularly if you're getting towards 47 figure, that's what economists cite, that there may be some recessionary effects within the area, then that's one thing that the Fed could be keeping an eye on, albeit maybe this is the effect that they would want to see, and that should then, if less goods are manufactured, then that means that there is, although there may be more demand for the same amount of goods, it might mean that consumers may already be put off. Hence, there might be less production that is happening, or manufacturing that is happening within the US economy. Now, the University of Michigan sentiment at 59.2 compared to 63.5. 1 year inflation expectation of 4.2 compared to 4.6. 5 year expectation of 3.1 compared to 3%. And employment cost was at 1.2% compared to 1%. And if we look at the previous FOMC that we had on May 3rd, these are the highlights of the comments that we had last time round. Now, they said that the US banking system is sound and resilient. I wouldn't expect them to say anything else, to be honest. Otherwise, if they did, then that would probably cause more cause for concern for the markets than they would want it to. Toot the horn. Everything's all good. They're closely monitoring incoming info and assessing the implications. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation, and the extent of these effects remains uncertain. Then the Fed minutes from May 24th, you had that some participants noted concerns that Fed debt limit may not be raised in a timely manner, threatening significant financial system disruptions and tighter financial conditions. Of course, now that's out of the way with, so there's no more worrying about that. Participants generally agreed that the extent to which further interest rate hikes may be appropriate has become less certain. Several participants said that if the economy evolved along the lines of their outlooks, further policy firming might not be needed. So if inflation is heading down and the jobs market is still relatively adding a solid amount of jobs every month, then the Federal Reserve will then have to do less work and may not have to hike more in the future if their goals are being met. But if they do start citing less about inflation and more about the jobs market being quite hot and the need to bring that back down to a level that they would want to see it at, then again, the shift then goes from inflation to the jobs market, and there may be other economic indicators as well, like the initial jobless claims report. So again, but still the focus is on inflation. Some participants commented that additional policy firming will likely be warranted at future meetings. So again, not really close. They're not saying that that they're going to be done, but that they may need to continue raising rates. So nothing really surprising or out of the blue from the Fed there. Now, Fed members, what have they been saying? So Bullard said that the Fed will have to go higher on policy rate, perhaps a 50 basis points of more hiking this year. And off of the back of that comment, what we had seen is that the Dixie had strengthened and the S&P 500 had weakened. 26th of May, Collins said that the Fed may be or or near a point it can pause rate hikes. Post the PC price data, okay, that was stronger than expected. So again, like I said, it's a 4.4% compared to the prior 4.2%. Fed's Mester's response that said that today's data suggests that the Fed has more work to do and that her path for the Fed funds rate is to raise and hold for a time. So again, maybe she could influence the rest of the Fed members to say, okay, look, maybe we need to hike at this meeting and then do one more a 25 basis point hike and then see what happens to the economy and maybe pause at the next meeting. So again, that's one aspect that, or one comment that could mean that there might be a chance of a 25 basis point hike. Although, yes, as Pasliano says, hello, good to see you again. CME Fed Watch, and we'll go through that later ourselves, states that 97% chance. No, I've read that wrong. We'll get to that later. May 31st, Fed's Jefferson said a pause at the coming meeting doesn't mean rates are at a peak. June 1st, Fed's Harker said, I think we should at least skip raising rates in June. If inflation started coming down unexpectedly fast, then we could cut rates. But it's not his forecast. So this is the CME Fed Watch tool that I taken last week. So of course the current Fed Fed's target range, or the Fed fund range, is between 5% and 5.25%. Of course, the focus is the high end or the upper bound of the range at 5.25%. It was at 70.1% last week. Then this week, post CPI data that we had yesterday, 94.2%. We'll check this in the morning, actually. Actually, no, this was yesterday, but more or less the same today. 94%, looking at the rate to remain unchanged compared to 5.8%. Because of the data, there weren't any huge surprises. Although the markets were all over the place on the first candle, then markets started to price in the odds of a no change even more so compared to what they were seeing last time before the CPI report, at about a chance for a 25 basis point hike, about 30%. So again, usually what we've seen in the past, when the CPI data has surprised the markets, and I mean really surprised the markets, where it's been higher than expected across the board, then we've seen the markets try and look to price in a higher interest rate hike from the Federal Reserve, and then the central bank follows suit and thinks, okay, yeah, inflationary pressures are building, then we need to actually continue hiking by a bigger amount. This is in the time period of the mega rate hikes, and when we were seeing not just 50 basis point hikes, but 75 basis point hikes. So again, because of the data that we had back then, when data was much higher than expected, then the Fed led with a 75 basis point hike rather than a 50. So what I'm trying to say is that the odds of a pause happening today have increased, and according to the CME FedWatch tool, it looks more likely that could happen. Any sort of surprises that happen where the Fed decides to hike today by 25 basis points, of course, is going to go against the larger part of sentiment, which is expecting them to hold rates. What does that mean for the markets, and how will the markets react? Well, whenever there are surprises within the markets, whenever the expectation is not met or goes above or below the expectation, then there is more volatility within markets and the chance for bigger moves to occur. So if they do decide to go for a 25 basis point hike, the currency, the dollar, will love it. And the stock market won't enjoy it at all if they've been pricing in the odds of no change to happen with the Federal Reserve. But then we've got other bits of detail to go through, which is the summary of economic projections, which could then change the game, even if there is a pause that happens today with the Federal Reserve. So what I'm saying is there are a lot of things to look out for, okay? Which we need to kind of go through beforehand. Now, this is the previous summary of economic projections, as I was just talking to you about here. Again, it's saying the Fed funds rate at 5.1%. Now, remember, that's within the range of 5.1 to 5% to 5.25%. So we're already more or less, we're already there at the upper bound of that Fed funds target range. Now, what the markets might expect, and what could you expect from the summary of economic projections with the Fed funds rate, is if they say, okay, we may raise the Fed funds rate expectation to 5.3% in 2023, i.e. looking for an extra 25 basis point hike this year. If they go even higher, let's say they go to 5.6%, okay, or actually, if they go to 5.5%, going to the next range from going from a 25 to then seeing 50 basis points worth of interest rate hikes in total, then again that could have more of a damaging effect on the stock market in regards to sentiment. Even though Powell will then say in the upcoming press conference that's only projections, that's not going to happen, but we've already seen that that's not true. So we've already reached the Fed funds target rate of what they see. But again, the raising of expectations for the federal funds target rate past a scenario of 2 extra 25 base point hikes could make it worse for the stock market. Also, we've got to remember what they expect for the economy as well. If they expect the economy to be very strong and resilient, like the Bank of Canada had seen before they took their rate decision, again, that could add another headwind for the stock market if the Fed says, okay, we're not going to hike today because inflation is coming down nicely towards our target, but we know in the future that if economic growth is still strong, then inflation could continue to rise in the future, and that we may need to take extra action just in case to kind of keep things together and wrap it up nicely in a Pandora's box and keep it there. Also, the PC inflation expectations. If they expect inflation to be higher this year, that could provide us another headwind for the stock market. So, key things to look out for: the Fed funds target range. What do they think? What do they think the rate should be overall? Do they think that they need to go higher, or are they just going to stick to where it is at? Maybe go with 1 extra 25 and stay there, or do they decide to just flip the switch and say, okay, this is our last rate hike for a long time until they decide to pivot in the other direction and start cutting rates? Investment bank and economist and sentiment views. Again, quite key to what the markets might be feeling and how they might be influenced by the views of investment banks as well. So June 2nd, you had Fed-linked swaps showed a 25 base point hike fully priced in by the July meeting. Goldman Sachs on June 6th said that the Fed is most likely to add 25 base point rate hike in July, taking the terminal rate forecast rate to 5.25 to 5.5%. Again, if that appears in the summary of economic projections that they do another 25 base point hike, that might not really surprise markets. But if you go even higher than that, that could maybe cause some trouble there. June 11th, Deutsche Bank's Ryan said the Fed seems to be taking a timeout at the June meeting to continue to assess banking sector stresses and make sure that there are not any lurking problems. Goldman CEO Solomon said that we could muddle through with a much softer landing, and there's a reasonable chance that rates could go higher. So again, providing that the Fed maybe decides to go with continue raising rates after this meeting. Doesn't explicitly say in that comment whether they will do it at this meeting, but again, saying that the Fed isn't done with their hiking cycle, which makes it difficult for traders to try and pin down what the Fed does later on. Then, where do they pause? What inflation rate do they need to get to where they completely stop? Do they have to get to 2% before they slam the brakes and stop raising rates? Or maybe not slam the brakes, but put their vehicle in park and say, okay, that's it, that's done. Or do they need to wait till maybe we get to about 3% and they say, okay, that's good for us. So market pricing, we kind of talked about in the previous slide. US short-term interest rate futures add slightly to losses after the jobs report, with traders still betting on Fed's June hold. So the Bank of Canada and the RBA, is one thing that I want to talk about too. Now, they surprised the markets with a 25 basis point hike. Now, post the Bank of Canada's 25 basis point hike surprise, this is what Fed swaps did. They briefly priced in a quarter point rate hike by July, and they priced in just 1 quarter point cut in 2023 from the peak. If you remember back to the banking turmoil that we had seen from the fallout of SVB, what was happening then is that markets were actually looking at maybe 100 basis points of cuts by the end of the year from the Federal Reserve. So looking at a shorter time frame for the hiking cycle for then the Fed to flip the switch and go the other way. So this is now flipped and has changed again in the expectation that maybe other central banks not just the RBA and the Bank of Canada, but the Fed might go in the same direction and might surprise the markets and hike rates instead at this meeting rather than stay on hold. So just bear that in mind, okay? Two dollar denominated currencies, the two of the big boys, okay? The Australians and the Canadians. They're expected to hold rates. No, they both raised rates by 25 basis points. So don't put it off the table, is what I'm saying, that there could be the possibility that the Fed may decide to go with a 25 basis point hike at surprise markets. Just as a warning, just in case, if they do surprise the markets. Now, this was the last rate decision that we had seen, and we're then going to go to the deviations and talk about that in a bit more detail. So if we're looking here, so if we bring up the deviations too. Okay. So this is about a couple of seconds before that figure comes out back then that we had seen from the FOMC on the 3rd of May. So if we have a little play here. And then we'll talk about the sentiment too. So if you've looked at the deviations, we'll talk about why the markets might have moved in the way that they did. So you can see that the S&P and the dollar had moved initially in the same direction, and then the S&P flies up in the air. So what was the reason behind the Fed, or what was the reason behind that initial drop and then the flip of the switch? Well, if I kind of pause the video, I'll pause it there and I'll bring this here, the deviations. The deviations. So if you've subscribed to the mailing list, then of course you would have seen this beforehand. What was the previous sentiment for the Fed rate decision? And the deviation shows you how the markets react to economic releases. And that goes from the first candle, okay, to 10 minutes. So the initial, more or less, the initial market reactions that you see. You can see that the initial market reaction, that there was a 57 tick move towards the upside for the S&P after the way that candle had finished. Remember, this is going to the wake of the candle. And then there was 27 ticks down after about 10 minutes of trading. The NASDAQ had seen 202 ticks towards the upside. After about 10 minutes, it was down 55 ticks. And then the Dow, similar thing. It was up and then it was down after 10 minutes of trading. So what does that tell you on the stock side? Actually, not just on the stock side, but maybe just including the dollar and dollar yen and gold as well, that the reaction was mixed. Why? Well, here's what the sentiment was. So the Fed dropped the language that it anticipates more policy verbing may be appropriate to obtain sufficiently restrictive stance, but it doesn't explicitly say that they will pause in the statement at the next meeting. So a positive for the stock market that, okay, they're now moving on to the next stage. When? When are you going to do it? When? Again, of course, that ambiguity kind of leaves the door open to then whether or not there is, of course, first of all, when does that pause come? And then second, is there a chance for any monetary policy, maybe that the Fed might not be done if they haven't explicitly said that they're done with raising rates and they're comfortable with where they are at the moment, and to analyze how the economy is reacting. And then again, that puts off how the markets react. But of course, you've also got to think that the rate came in as expected. That figure itself wasn't a surprise. So when usually in those scenarios, and you can see it in the past here, unless there is sentiment kind of flips the market in one direction, usually that if the data comes in, the figure comes in as expected, you see more of a choppy initial reaction, okay, from the markets, across all the markets, before you see a nice clean move. Sometimes the reactions might be small, again, depending on what the sentiment might be of the market at that time, or what's being said by the Federal Reserve. If there's been a repeat of what's been said before, then maybe there could be a little bit of a pop, and then a bit of whipsawing, and then the market's kind of carrying on with their move. Or if there's a really strong Fed statement in either the dovish or hawkish direction, then that could lead the market in one direction rather than having those chops. So you can see here again, when the Fed's medium view back a while ago, actually going to go back on December 14th, when the Fed's medium view Fed funds rate at the end of 2023 was at 5.1% compared to 4.6%, expecting a higher Fed funds rate. So a clear indication that the Fed needs to do more rate hikes by a much bigger amount, a higher projected rate that led to stocks declining instead, and a strong reaction from the dollar overall in the market. So again, that was a clear direction that the Fed went down. The Fed went down with that caused that strong market reaction. So let me summarize that. You have the rate. If it comes in as expected, then you're looking to the statement and also the summary of economic projections to give you an indication of whether the Fed has a stronger bias to the hawkish side or the dovish side. If the sentiment is, or if the headlines that come through, if it's mixed, then that could mean that there is more whipsawing and there isn't going to be a clear direction until markets make a clear direction from themselves once they've kind of taken in all the headlines to get an indication of what they would want to see before they jump in or continue to stay in their position or to take on any further risk. It's difficult, is what I'm saying. You've got to look at everything together. You can't just look at the figure by itself. You've got the statement and the summary of economic projections. Wham, bam, here you go, ma'am. There you are. Okay, so let's go to some of the things that I wanted to discuss as well. Now, very simple and easy. If the Fed decides to raise interest rates at this meeting, like I said, the currency would appreciate, the stock market wouldn't take kindly to it, and then you would see you'd be more or less you'd be looking for a hawkish statement from the Federal Reserve to back up the reason why they had decided to go with a 25 basis point hike at this meeting rather than a pause, like the Bank of Canada did when they took their rate decision as well to decide to hike interest rates. And the RBA, when they said that inflation is still too high at 7%, and they said, hey, we need to continue raising rates. We're not done yet, even though they had paused at one meeting before they decided to go with another rate hike. So this is what we need to be aware of the risk if they do decide to raise interest rates and follow their brethren, huh? They're all in it together. Woo! If they decide to, for whatever reason, if they decide to cut interest rates, of course I have to talk about this because somebody's going to have it in the back of their mind somewhere out there in the world, sitting at a computer or a laptop or sitting on their phone thinking the Fed might cut rates. Well, good luck to whoever that is, or whomever. But if they do decide to cut rates, of course that doesn't favor the currency. That would favor the stock market, because that means that borrowing costs go down and that there is then support given to the economy to go even higher. Okay, you'll basically be asking the Fed to pull an Erdogan to say you cut rates instead. You keep cutting rates and inflation will go down, baby. But we know that's not the case, because we've seen. I'm sure he's sitting somewhere enjoying some Turkish tea somewhere. Whatever he's drinking, man, we need some of that here in this place, because yeah, it's going to get a bit choppy if that were to happen. Anyway, so that's out of the way with. That is basically, I've gone through that quite quickly. That is the summary of what to expect. Let's kind of go back to the video. We might as well just finish it off to where we got to. So you can see that, that there was initial little blip down, and then the markets and the S&P went towards the upside if we kind of move forward. And then you can see that on the stock market, okay, that there wasn't a clean move compared to what we've seen on the dollar yen and gold. Okay, so if we go back to what the biggest movers were actually in the markets, so the dollar yen had seen about 32.5 pips down, and after about 10 minutes of trading, it was up 14 or 15 pips towards the upside. The biggest reaction that we had seen last time round was on the euro dollar, which had an initial move of 36 pips up, and then it held, well, not all of it, but it kind of clawed, it kind of went back down, but it was up after 10 minutes of trading by 6 pips. The rest of the market didn't really have that much of a reaction, to be honest, in the currency space. If I pause the video again, I'll bring it up here so you can see everyone else more or less, I mean, even with the euro dollar, you could say, so more or less went back to their prior levels instead. So what does that tell you? So what does that tell you then? If we look at gold, I know we have Patliano who's been talking about gold earlier on in the chat. Patliano said last time gold went up a little bit after 25 base point hike as expected, but then went to all-time highs after a minor suggestion of a pause for the next one. So this was the initial move, okay? So you had 86.5 ticks towards the upside initially, okay? And then after 10 minutes of trading, it was down by 26 ticks. Overall, it wasn't there was a decent reaction from the markets, but there wasn't a continuation enough for the markets to stay in one direction because of the confusing sort of the confusing comments that came through from the Federal Reserve. Real Idiot says, "Hey Tony, are you hyped? I'm hyped. Are you hyped? I hope you're all hyped." Gosh, it's really hot in here. I hope you guys are enjoying the heat as well. So, yeah, I've got what have I got here? If you guys have you guys tried fully ripened mango juice? We've got a bit of time. We've got plenty of time. That's why I'm talking about mango juice here, right? If you've tried ripened mango juice, that's the best juice that you can have. I'm not advertising a particular company. I'm just thirsty. So... and mango juice is just really good. All right, so enough with the involuntary advertising there. Hope nobody tries to claim that. I have not even said the company's name. Let's get into some of the other areas we're going to be looking at too. So, Sparrow says 8:30 p.m. in Kenya, and I'm taking coffee. Patiano says Tony is in. What the heck? What? Dude, what are you on about? How do you tell somebody who's raised through listening to their voice? Jeez. You never know. I could be Russian, I could be Spanish. I could even be a Korean. How'd you know? Anyways, let's go to some of the other places. So, FinancialJuice, okay, let's get our setup sorted. Actually, let me kind of skip forward, see what else we had. Yeah. So, even as I'm kind of going towards the end of the video, kind of see that the reaction didn't really hold, the initial reaction didn't really hold that long. Mango is an Indian thing. No, it's not just an Indian thing, I'll tell you that. Maybe I've got an Asian friend who said, hey, here's a mango. You'll enjoy it. Okay, let's get out of that. Let's go to the FinancialJuice website and get that all set up. Let's get a TICKSTRIKE set up as well. If you've used TICKSTRIKE before, then you will know how useful it is. If you don't know what TICKSTRIKE is, then TICKSTRIKE basically allows you to listen to order flow in the markets. That's in Forex, crypto, stocks, futures, crypto I've already said, ETFs and ETNs, and your internals like the VIX. So here we go. Let me get the US releases set up here. If I do go a bit quiet, then I'm just kind of to make sure I get everything set up in the right way that I want it to be set up. So TICKSTRIKE. So this is our little ticker box here. This represents the strength of the buying or selling momentum that is occurring within the markets. All right, so again, just kind of before we go continue on, if you've enjoyed this video so far, if you found it useful, then don't forget to like the video, subscribe to the channel, get the word out there, brother. And then let's see how the Federal Reserve, what the Fed puts on the plate for us. So here, going back to TICKSTRIKE, what it shows you is the strength of the buying or selling momentum within the markets, okay, or within the asset that you're looking at. So this figure here, the minus figure, of course, shows you the selling, and then the opposite, vice versa, shows you the buying amount. The figure here, number 1, is the most sensitive to market reactions. So when there's a little bit of buying or selling momentum that occurs, so you can see here with the dollar yen here, then TICKSTRIKE will pop off. Now, if you only want to see where the markets, if there's a lot of buying or selling momentum, then you can chop and change this to whatever figure you want. If you keep going all the way up to 15, which is the least sensitive to market reactions, only when there's a big amount of buying or selling that is occurring will TICKSTRIKE go off for you. So if you're a day trader, if you're scalping the markets, then again, it's another tool to add to your arsenal. There is a free 7-day trial for you to have a look at and have a try, a play with. But if that's not something that you're ready to do at the moment, of course, it's totally down to you. You do also have to change and then look at other areas or other assets within an asset group that you want to look at. Of course, you have the S&P 500, the Euro-Dollar, oil, and Bitcoin, and that's restricted to a certain level of sensitivity, which is escaping my mind at the moment. But that is one way that you can have a little play around with TICKSTRIKE, see if it's something that is for you. Again, if you're a day trader, you're scalping markets, again, that's another tool to add to your arsenal. So even if you don't purchase it, you've still got not only the free 7-day trial, but then you also have this to play with here too. But again, totally down to you on what you want to have a play with. Now, actually, let me bring up one more here. Let's bring up Bitcoin here as well on TICKSTRIKE. Here we go. Let's go. I'll put it. We'll go here. Okay, we'll put it there. Oops. See how that reacts. Okay, so if anyone's question is about intermarket correlation, how will Bitcoin react? Whenever the dollar strengthens, okay, then you see the inverse reaction on Bitcoin. If you do see, let's say the Fed does decide to go with a very hawkish statement, then it goes with if they do decide to go with a higher interest rate with a hawkish statement, that would really boost the dollar. But then, of course, the inverse relationship is that Bitcoin will see a decline instead. Of course, more monetary tightening means that taking on risky assets doesn't become that. It becomes less attractive. That's the general overview, and that's with other risk assets as well. If you're talking about the stock market, if you kind of missed the earlier part of the presentation of the stream that I did, I'm not sure if you're actually able to kind of go back on the video. You might be able to go back on the video and start from the beginning if you wanted to. So FinancialJuice. So that's TICKSTRIKE. That's out of the way with. So FinancialJuice. What is FinancialJuice? A live voice and text service. Let me kind of move these out of the way here. Okay, let's get this here. So FinancialJuice, a live voice and text service that keeps you up to date with what's moving the markets. Okay, why the markets are moving that way, and also the important headlines that will affect sentiment, or that could have an effect on sentiment throughout the trading day as well. All here via your voice feed, which is this little button here. Okay, that plays the sound here, and then you also have your news feed of text. Again, as said, in real time as well. That gives you an up to date news of, real time news of what central bankers are saying, maybe about monetary policy, maybe there is some escalation in the Ukraine-Russia conflict, or let's just say something really wacky happens. Maybe there's a black swan event that occurs that takes the markets by surprise, and you're not sure why the markets are jumping up and down. Of course, while you might be taking the initial trade, you want to know what the heck's moving the markets. It might be that China decides to invade Taiwan, or that the Saudis cut off oil to the West altogether, or from everyone, as just some of the examples of a black, or what are the black swans, what are the sort of black swan events that could occur. Nicholas the source says black swan is when PNB breaks to 100. that would definitely be one. But yeah, so again, all you need to know, all in one place, your market risk as well, what to expect, or what could have an effect on the markets later on in the trading session, or what already had an effect on the markets, in the markets already. Again, that's all in one place for you to have a look at, alongside with your economic calendar here on the left-hand side as well. Okay, for the economic releases for the week ahead, and of course the current day. So, and then you can kind of have a good gauge of, whether or what the market might have been affected by earlier on in the morning before you start your trading day. If you have a look at, try and correlate the times to your charts. What else do we have here? So that is FinancialJuice. So now, what is the difference between Pro and the live version? So the Pro version, okay, has no adverts playing like the live version does, no advert banners, has real-time voice and text news, and you also, again, that's also real-time across the whole platform in the Pro version, including the economic calendar as well. And you also have access to the news desk as well. So the news desk, of course, if you have any questions about why the market might have moved in a certain way, why did the S&P fly when you might have expected it to go down, or was there a headline that we might have put out that we can find for you? Say, hey, here you go. Here's the reason why. Again, the news desk is there for you, for the Pro users to have a look, to utilize to their best that they can. So all of this, we hope, okay, feedback is always welcome. All of this data should provide you with a really great tool to enhance your trading, or to add to your tools that you may already have. So what we want to do is there's also at the moment, there is a 7-day free trial of FinancialJuice, but on top of that, there's also the lifetime Pro offer for FinancialJuice, i.e. for $997. That's it. You have lifetime FinancialJuice Pro forever with a lifetime money back guarantee as well. Now, if you don't have FinancialJuice, if you don't have a FinancialJuice account already, before you make any payments, if that's what you want to, do, then make sure you have an account first. Sign up, get your username and login. Go to your email, verify your account. Go back, make your selection for your subscription. Once you've done that, log out, log back in, and you should see this beautiful site. And where it might be able to sign up for the FinancialJuice Pro, well, there'll be a button here if you're on the light version. Once you've created your initial account, to say Go Pro here, and you can go through with that. That's FinancialJuice Pro right there. So let's minimize that. Let's get everything ready. We have plenty of time. Whew. All right, we've got about less than 11 minutes now. All right. Proclaby says, I hope you're getting over time for doing this instead of sitting in your garden with a beer. In this heat, yeah, maybe, it could be an idea that you just kind of get knocked out. Just let the heat take over your body. Relax. And just fall into a deep sleep. Anyways, that's all. And then finally, one of the points too is MACROACE. Now, of course, I did go through the deviations for the economic release. That is completely free. And all you've got to do is sign up to the mailing list. And again, you get the deviations for the releases for the upcoming week ahead. Okay. And you get a short summary of what to expect in the Europe session, US, and Asia. And a summary of the weekend news, if there is anything to summarize for the weekend at all. It's not filled with line graphs or charts or a bunch of figures, okay, in those paragraphs. It's just a couple of paragraphs here and there giving you a short, quick summary of what to kind of expect. The general gist, okay, is what people need. What people need to know. Then here in the presentations, the live streams that I do, is where you get further detail. And again, you get a nice, clearer picture of what to kind of expect. So again, the MACROACE mailing list is, ta-da, that is the list there. Yeah, we'll look at gold. We will look at gold. We'll take a look at it. We've also got a stream here too. Actually, I'll put it up here. I'll get it ready too. Bonds are going to be quite important to see as well, of course. So we're looking at the dollar yen, S&P. We have the 2-year bond here, 2-year bond futures here with ZT, and we've also got gold up and ready as well. So we've got gold and TICKSTRIKE bonds there, and Bitcoin as well. All right, let's see what this baby pulls out. So if I do go silent, I'll be back in a couple of minutes. We've got about 8 minutes left. Okay. Hold on to your seats, because we do have to go through the headlines too and kind of give a little breakdown of what the Fed might be saying and why the markets, or maybe why the markets have not moved at all, depending on what the Fed does and says. All right, I'll be back in a sec, guys. Okay, I am back. We are ready. We've got about a minute left. If you guys thinking, somebody said, is this live feed dead? Well, there wasn't anything else for me to talk about. I was more or less done. Just sipping on that mango juice. Apparently that makes me Indian too. Anyway, so gold, bond prices, I think we'll kind of stick with the look on gold, keep an eye on the dollar yen. But then we also do want to have a look at how the bond markets react as well. That's going to be important. So less than a minute to go. FOMC summary of economic projections, a rate statement, and the figure itself. Hallelujah. Let's see what the Fed does, huh? Do they surprise the markets and go with a 25 basis point hike at this meeting, like the RBA and the Bank of Canada did, or do they stand pat? Okay. Here we go. 10 seconds. Let's see what this baby pulls out. Okay, no change. Rate remains unchanged as expected at 5.25%. So again, rate remains unchanged at 5.25%. Dollar yen going up with the S&P going down. Headlines, what do we get through here from the markets? Statement, policymakers see higher GDP growth in 2023 and low unemployment rate and less progress on core inflation than they saw in March. Fed officials see Fed funds rate at a median of 5.6% at the end of 2023. So higher than what they were expecting of maybe an extra 25 basis point of rate hikes on what their previous summary of economic projection was, seeing the Fed funds rate ending at 5.1%. So again, much higher than what the expectation is. Okay, so as said, dollar yen going up basically off of that bit of news. So because they've extended they've gone with a higher expectation for the rate, there is much more tightening to do. Let's do some initial measuring. I think that's all we're going to need, really, from the statement itself. It's 51.5 pips towards the upside on the dollar yen. Gold, there we go, takes a hit. Big old smack in the face. We're not done yet. We're tightening. 78 ticks down, or about 79 ticks down. S&P. Let's see here what happened here. So again, like I said, the statement also matters too, and the summary of economic projections. 50 ticks down on the S&P. It's like a bond prices too. Bond prices heading lower on the 2-year. Had a huge old drop. Oops. What's that? Okay. Okay, that's 68 ticks towards the downside there on the 2-year bonds. What else do we have? Let's have a little look. What else have we got from the Fed? So they see core inflation at 3.9% at the end of 2023, 2.6% at the end of 2024. What else do we have? The US 10-year yield, bearing my market reactions, curve inverts further to a negative 93.7 after the Fed statement. US short-term interest rate futures drop after FOMC decision as traders price in more Fed rate hikes ahead. Let's see. Fed says holding rates allows the FOMC to assess additional data. So a hawkish hold is what we got from the FOMC. Baby. Seems like that mango juice, maybe I'm seeing things. No, I'm not. All right. Somebody on the dot, Ali said that I'm gambling a bit on the market for a rate hike, a strong dollar. Well done to you, Ali. He said, yeah, got it. Real Idiot said, hawkish skip, lol. What Orwellian speak? Tech taking an instant hit. Yeah, 60 points and out for Ryushi. Thanks for commentary and all the best from London. I won't say the postcode because, I mean, although London's a huge place, you never know. Somebody might have a particular set of skills. They will find you and they will. Anyway, so there we go. So let's have a look here. So if we see any further bits from the statement. Okay, so the CGDP in 2023 at 1% and 1.1% in 2024, so we're not really far off the mark. Yeah, so here's some more data with the median forecast. So Fed median rate forecast rises to 5.6% at the end of 2023 and 4.6% at the end of 2024. Now, let me get the SEP myself, and let's have a little look through it together. Let's see what we get. Okay, so then we can get to the nitty-gritty of this here. Let's kind of extend the window. Okay. Oh, okay. Okay, there we go. Let's move TICKSTRIKE out of the way for now. Here we go. So, see that? The March projection was 5 for 1, and then by 0.5, they're expected to reach 5.6%. Okay. And then also for 2024 and 2025, they expect higher rates of, or the higher than expected rate where they previously saw it. Now, you may have thought that maybe they would bake in another 25 basis points worth of hikes, but it looks like they're going to maybe do a couple more there, if that's what they're looking to do. All right. PC inflation is also core piece inflation is up in the current year, but not with a PC inflation. Unemployment ticking down. GDP, or real GDP, or the GDP data quarter, expecting to be much better than they had expected it in the March projection. So that's also another tailwind for the markets. What else have they got here? We can see. Let's have a look here. So there we go. Okay, that's the dot plot there. So let me that is kind of moving out of the way. I want you guys to see this as well. Whoops. Okay, so here we are. Current dot plot expectations. So yeah, it's quite a. You can see that there was there's a leaning towards a high rate of interest rate for 2023. So you can see there's quite a few of them looking at about 5.6 around the 6% range. Be that one who was going, okay, the markets are taking hit. That's just with TICKSTRIKE and also Bitcoin. If anyone was focusing on that there, if you're looking at that on screen, but there you go. So expecting a higher rate in 2023 and then 2024 again. A couple of the three allies probably would be Bullard, of course, would be one of them. Maybe Fed's Waller as well could join them too. We'll see who would kind of expect who the other one might be. Maybe Mester, maybe who's got her expectations for the Fed rate decision. All right, so let's have a look here. And then 2025, yeah, it's a bit cleaner. Well, it's not as clean. It's all over the place, really, with expectations. All right, let's close that window. Actually, no, I want to go further down. There's quite a bit more to go through here too. I mean, the release is more or less done now. The key point being there is that they see the Fed funds rate at a median of 5.6% at the end of 2023. So that's what's caused. Again, if you're just joining me now, thank you very much. And don't forget to like and share and subscribe to the channel. Get the word out there if you found this information useful. If you didn't, well, let us know. let us know what we can improve. I will be sending out a survey as well to you guys. Well, actually, if you're on the mailing list, I'll send it out there. Maybe. Okay. So what else we have? Charts. Cross. Let's see. Okay. Yeah, I mean, more or less has been said in the headlines is all we need to know. And holy moly. Okay. There we are. So I want to have a look at. Now, the euro dollar was the one to see the biggest reaction in the currency markets last time around and the FX markets last time around. So let's have a look at see if it's outdone the dollar yen. That was 51.5, 51.7. Okay, and see, has it had a bigger reaction? Try and be, nope. Dollar yen had the bigger reaction this time around. Cable. Okay, 22.5. Yeah, okay. Let me just double check that. Oops. Yeah, okay, that's correct. Yeah, okay. Fine. Okay, cool. All right. So, ladies and gentlemen, thank you very much for joining me for this live stream of the FOMC rate decision. They did a pause, but it was a hawkish surprise with the summary of economic projections. So, if you found this information useful, if you like the content, if you like me, if you like mango juice, then definitely hit that like button, subscribe to the channel, and get the word out there. Now, tomorrow, as I said, we have the ECB interest rate decision, where they're expected to continue their hiking path. So I'm gonna grab the video for you to actually have a look for that. Look at that tomorrow in the morning. Well, it's at 8:15 a.m. Eastern time is the rate decision. We'll be jumping on doing 30 minutes of prep at 7:45 a.m. Eastern time. So if I just get the video up here for you, there we go. There's a link. There we are. All right. There you are. Sparrow says, I like for the mango juice. David Del Sid says, thanks. Nice to have someone talk at this moment. Patrina says, thanks, Tony. I'm buying a mango juice sometime. Well, it better be good. I'm sure it'll be good. Yeah, well, there looks to be a bit of a recovery for gold. I think that's, we are seeing a little bit of reversal on the dollar yen, but it depends again. That was a strong initial move from what we'd seen from the markets there, particularly on the dollar yen. All right. Valentin Gobi says, why is it bullish for the dollar? The main reason why it's bullish for the dollar, again, it was the summary of economic projections. So like I said, the rate could come in as expected, but it's the statement and the summary of economic projections that is provided alongside it that could flip the market, and then this is what you get, okay? You get this. They said that they see a Fed funds rate at a median of 5.6% at the end of 2023, rather than what their previous summary of economic projection was of 5.1%. So now, if you remember in the past, you had, so again, Nicholas de Souza saying it's strong because it indicated more hikes. Okay. You already had economists expecting maybe another hike from the central bank of 25 basis points. Okay, taking the rate would take the rate to 5.5%. Okay, and then the new range, again. Then the new range would be 5.25 to 5.5%. Remember, the upper band is what traders focus on. But this going to 5.65% indicates that there's probably going to be maybe another 25 hike down the line. If you actually remember in the prep, Bullard was the one who said that he would want to see he would want to see not 250s. Jeez, I get no respect. He would want to see another 50 basis points worth of hikes, or thinks there could be another 50 basis points worth of hikes before the end of the year. So, if again that's the sentiment that's played out, and that's what the Fed more or less said that they would probably do. They have met their expectations most of the time. Anyway, Jamie Dimon said 7%. Well, we'll see about that. Again, we just got to kind of see how the data is and what does Powell say at his press conference. I won't be covering that. What we can do is jump onto the FinancialJuice newsfeed. Again, the link is there pinned at the top. Make an account for yourself, completely free. You don't have to go with a pro version just yet if you don't feel comfortable with that, or if you're not sure of how to use a live voice to text service. If you're unfamiliar with what that's like, then again, have a little play and then see what you think. But of course, you get the live voice from Robert, who is speaking on the mic at the moment. So he's done a pretty good job. Well done, Robert. RC says, thanks, mate. Appreciate your insights, with some nice flowers. All right. Ladies and gentlemen, thank you very much. I've put the link in there for the stream tomorrow for the ECB. Enjoy your evening, and I will see you then. All right. Take care.